Welcome to FX Signal Team. In our last video we had already provided you course outline, and thus we are starting the first section of part 1. Section 1. An Introduction to Forex. Forex 101. The Basics. So, what is the Forex market? Foreign currency exchange is the act of exchanging one country's currency for that of another. It is conducted by international banks, large financial institutions, large corporations and companies, and price action traders like you and I. The foreign currency market is also known as the Forex or FX market. The open market trades non-stop from Monday 8 a.m. to Saturday 8 a.m., opening in New Zealand and Australia, and closing in the USA after Wall St. closes on Friday afternoon New York time. Forex is the largest and most liquid market in the world, with an average daily turnover averaging $5.3 trillion a day according to the Bank for International Settlements. No central exchange. Foreign exchange is an over-the-counter, OTC, market. That means that there is no central exchange and clearinghouse where orders are matched. Geographic trading centers exist around the world, however, and are, in order of importance, London, New York, Tokyo, Singapore, Frankfurt, Geneva and Zurich, Paris and Hong Kong. Essentially, foreign exchange deals are made between participants on the basis of trust and reputation to deliver on an agreement. In the case of banks trading with one another, they do so solely on that basis. In the retail market, customers demand a written, legally accepted contract between themselves and their broker in exchange of deposit of funds, on which basis the customer may trade. The primary reason the Forex market exists is to facilitate international trade and investment by giving businesses the ability to convert one currency into another. As an example, a U.S. business can import goods from Japan and pay in Japanese yen, even though the business is based in America and operates in U.S. dollars. The Forex market also provides a medium for speculation, which works to add deeper liquidity to the market, making exchange rates less volatile. The carry trade is facilitated via the Forex market. This is a trade in which investors can buy high-yielding currencies against low-yielding currencies and profit from the higher-yielding interest rate. Basic history of Forex. Okay, I admit, this part is going to be a little bit boring, but it's important to have some basic background knowledge of the history of the Forex market, so that you know a little bit about why it exists and how it got here. So here is the history of the Forex market in a nutshell. In 1876, something called the gold exchange standard was implemented. Basically, it said that all paper currency had to be backed by solid gold. The idea here was to stabilize world currencies by pegging them to the price of gold. It was a good idea in theory, but in reality it created boom-bust patterns, which ultimately led to the demise of the gold standard. The gold standard was dropped around the beginning of World War II, as major European countries did not have enough gold to support all the currency they were printing to pay for large military projects. Although the gold standard was ultimately dropped, the precious metal never lost its spot as the ultimate form of monetary value. The world then decided to have fixed exchange rates that resulted in the US dollar being the primary reserve currency and that it would be the only currency backed by gold. This is known as the Bretton Woods system, and it happened in 1944. I know you super excited to know that. In 1971 the US declared that it would no longer exchange gold for US dollars that were held in foreign reserves. This marked the end of the Bretton Woods system. It was this breakdown of the Bretton Woods system that ultimately led to the mostly global acceptance of floating foreign exchange rates in 1976. This was effectively the birth of the current foreign currency exchange market, although it did not become widely electronically traded until about the mid-1990s. Okay. Now let's move on to some more entertaining topics. Who trades Forex? Central banks, governments, commercial banks, large financial institutions, insurers, commercial companies or exporters and importers, mining and car companies, etc. Hedgers, for example, airlines, farmers, etc. Locking currency prices as well as hedge products via offshore commodity futures. Commercial traders, hedge funds, retail traders, you and I, and travelers and tourists. What is Forex trading? Forex trading, as it relates to retail traders, like you and I, is the speculation on the price of one currency against another. For example, if you think the euro is going to rise against the US dollar, you can buy the EUR-USD currency pair low and then, hopefully, sell it at a higher price to make a profit. Of course, if you buy the euro against the dollar, EUR-USD, and the US dollar strengthens, you will then be in a losing position. So, it's important to be aware of the risk involved in trading Forex, and not only the reward. How are Forex currency rates determined? Economic factors. These include economic policy made by government agencies and central banks, and economic conditions as described by and through economic reports, as well as various economic indicators. Political conditions, international, national, and regional political conditions and events can have a large impact on the Forex currency markets. Market psychology. The psychology of market participants can influence the foreign exchange market in numerous ways. Ultimately, all economic variables are expressed through the filter of the human brain or trader psychology. Trading algorithms. Electronic trading based on algorithms, or computer or robot trading, is becoming more and more popular. As a result, algorithmic trading is starting to have a large effect on Forex currency rates. All of these determining factors are reflected via the price action on a raw price chart. This is why price action is the best trading method. By learning to interpret and trade it, you are also taking into account all variables that move a market in the simplest and clearest way possible. What are the most traded Forex currencies? These are the most traded Forex currency. Some of the advantages of trading the Forex market. Forex is the largest market in the world, with daily volumes exceeding $5 trillion per day. This means dense liquidity, which makes it easy to get in and out of positions. Trade whenever you want. There is no opening bell in the Forex market. You can enter or exit a trade whenever you want, from Sunday around 5 p.m. Eastern Standard Time to Friday around 4 p.m. Eastern Standard Time. Ease of access. You can fund your trading account with as little as $250 at many retail brokers and begin trading the same day in some cases. Straight-through order execution allows you to trade at the click of a mouse. Fewer currency pairs to focus on, instead of getting lost trying to analyze thousands of stocks. Freedom to trade anywhere in the world, with the only requirements being a laptop and internet connection. Commission-free trading with many retail market makers, and overall lower transaction costs than stocks and commodities. The greater liquidity found in the Forex market is conducive to long, well-defined trends that respond well to technical analysis and charting methods. Traders can profit in any market condition. Also, there is no inherent structural market bias like the long bias of the stock market, so traders have equal opportunity to profit in rising or falling markets. Due to these factors and others, the FX market has been referred to as the market closest to the ideal of perfect competition, notwithstanding currency intervention by central banks. In the image below, it can be easily seen how the Forex market's $5.3 trillion per day trading volume dwarfs the futures and equities markets. While the Forex market is clearly a great market to trade, I would note to all beginners that trading carries both the potential for reward and risk. Many people come into the markets thinking only about the reward and ignoring the risks involved. This is the fastest way to lose all of your trading account money. If you want to get started trading the FX market on the right track, it's critical that you are aware of and accept the risk involved in every trade you take, and focus at least as much on risk, if not more, than you do on reward. Misconceptions about Forex trading. Does the Forex have a higher level of risk than other markets? No, this is not true. In fact, the Forex market is probably the easiest market in which to control risk due to very high trading volumes and liquidity. This allows us to enter and exit instantly. Furthermore, Forex trading allows us to input our entry and exit points into the computer before a position is even taken. Of course, there is always an element of risk involved in any trade taken. Our next lesson will be Forex jargon and trading times.